And good morning once again, options traders. Well, are you forgetting to consider stock price and time? I'm finding that most traders are. I've had a number of conversations with traders and a number of email conversations, and I find that they still forget this concept. And even though we've talked about it many times, I think the problem is that most options traders come from a stock trading background. And when you're trading stock, remember that stock is a one-dimensional asset, meaning it's up or down. If you think the stock is going up, you buy it. If you think it's going down, you can sell it or even go short. But that's really all you need in the analysis is up, down, just this one dimension. But that's not true for options. For options, you must analyze the stock price. That's always going to be true. Now, for options, we can look at up, down, or neutral, but you also have to consider time. And if you do that, putting these two pieces together, stock price and time, you'll have a better idea of what you can expect, and that can only mean better outcomes. So to understand why, let's go find out. And as always, before we get started, please be sure to click like and subscribe. It's definitely very much appreciated and helps to promote the channel. So remember again that options are about direction, magnitude, and speed. So there's really three components. Remember, stock is just about direction. Options are direction, magnitude, and speed. So for the direction, yes, options need direction, and that just means are you bullish, are you bearish, or potentially even neutral. So we might call that a lack of direction. But we need to have some type of opinion on that before we can figure out which strategy will be best. However, unlike shares of stock, if we're looking at bullish or bearish, we can't just say, I think it's going up and stop there. We need to say, how bullish or how bearish are you? This is the magnitude side of the option. And that's because there's an extrinsic value or a time value that you have to overcome. That break-even point is pushed out further than it is for shares of stock. So it's not just a question of being bullish or bearish. We need to have some idea of the magnitude. Are we looking for the stock to go up $1 or $2, or are we looking for it to go up 10 or 15 bucks? That's what we're talking about for magnitude. And then finally, speed. How long will it take? Because there's a big difference between thinking it's going to go up 5 points by the end of the week versus 5 points by the end of the month. Those are two vastly different outcomes and require two different strategies. So to see why, visually, let's take a look at a $100 call. As always, here is the bend that lines up right at 100. This black curve is the expiration graph, and this blue one is the current curve. Now, I've drawn these with 30 days to expiration and 30% volatility. So the option is worth about $3.43. But let's advance the clock 5 days to 25 days till expiration. Notice that that blue line dips down a little bit. And that means that all prices, regardless of which stock price you're looking at, all of them get reduced. They definitely get reduced more here towards the center. You can see there's a bigger separation between the blue and the gray if we're near the center, as opposed to out here when the option is deep out of the money. Can hardly tell a difference between the blue and the gray lines. Or if it's deep in the money, can hardly tell a difference up here. But you can definitely see a little bit of a difference here. Let's advance the clock 5 more days to 20 days till expiration. We're going to dip down some more. 15 days to expiration, 10 days to expiration, 5 days to expiration. And then, of course, from here, we're just going to quickly work our way down from the red line to the black. The black line, again, is the profit and loss diagram on expiration day on the closing bell, or at least into the final seconds of that. That's the only time that black line is used. So yeah, you can see there's not maybe a huge difference between 30 days and 25 days, but that might be a lot to ask from a stock to make a significant move. What if it does take 10 or 20 or 30 days? Now we can see there's some big differences. So to clean up the graph, let's get rid of some of these lines here. Let's just look at the blue line, which is, again is 30 days to expiration, and this purple one down here, which is 15. And so now we can see that, yeah, there's a difference if we're only looking at the direction, but we're not accounting for time. If we go even further from 30 days to 5 days, now look at the separation. Once again, not a big difference way out here if the option's deep in the money because all of your extrinsic value is gone, or if the option's deep out of the money, again, because all of the extrinsic value is gone, or at least most of it. but a very big difference in here. So let's say if the stock is up here at 105 with 30 days, we might see that there's a $3.14 profit, but if it's within the last 5 days, it's now a $1.70 profit. See, it's just a question of whether we're reading off the blue line or the red. So you might say, well, there are profits in both cases, and that's true, but that's for this example. Maybe we're only looking at a 1-week option with 20% volatility, and those are going to have vastly different outcomes. But what if we're expecting the stock to maybe go to 103 down in here? Again, big difference. If it's at 103 with 30 days, in other words, the same day you bought it, that's a $1.76 profit. But if it's with 5 days to expiration, you're down here, that's actually a 3-cent loss. So in both cases, the stock went up to 103, but depending on the time that it takes, that can lead to very different outcomes. So the thing that you really have to do, especially for all of our new traders in the group, is go to a pricing model, or if you have Thinkorswim or E-Trade, they will show you these risk graphs, but stress test your positions. So when you stress test your position, don't just look at the thing that you think is going to happen. I think the stock is going to go to 105. All right, that might be fine, but what if it goes up 5 points, or what if it falls 5 points? What if it goes up 5 points in a week or down 5 points in a week? What if it goes up 3 points in a week or down 3 points in a week? And get some ideas of some ranges of the profits and losses that can occur. Next, do the same thing for a different point in time. What if the stock goes up 3 points or down 3 points, but after 5 days have passed? Or after 10 days have passed? And this is what I'm talking about when I'm saying to stress test your positions. It will put you into a much better position of things that are more likely to happen than just saying, I think the stock is going to 105 and the pricing model says I'm going to see this profit. Because the chances that you hit everything exactly right, the direction, magnitude, and speed, is really slim. And that's only going to open up the doors for regrets. Stress test your positions, and mainly consider stock price and time before setting up your strategies. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.